Hello, we are currently live. How you doing, Amanda?
I'm doing good. Happy Friday. How are you?
Oh, happy Friday, girl. I'm doing well. I can't complain. I can't complain.
Same here.
So, what today is a good day. It
Today
is
is a
nice
good day.
today. It's nice and somewhat warm, but not as cold as it could be. Um,
Right,
we just wanted to stop in and pop in on our Friday evening and talk about wonderful real estate and loans.
right. So today's topic, we're going to be talking about manufactured homes and condos. And I
the
thought this was a
difference, the difference between mobile homes and manufactured
manufactured
homes.
homes,
Yeah,
right? And then we're going to dip into condos. And we thought this was a really good subject because a lot of people don't know the process for purchasing a condo and the rules when purchasing a condo, using certain type of loans. And then with manufactured homes, that's kind of like a whole nother beast. It's a lot of different requirements when you're purchasing a manufactured home. And then we're going to go a little bit deeper and talk about refinancing a manufactured home as well. So just so people know if they're looking like to build a home, because a lot of people are going into that manufactured. It's becoming a little bit more common for people to do manufactured homes
exactly.
because of the time. It's a little bit quicker to get your home built, but it's also a little bit of I guess I want to say a harder process in the future if you wanted to refinance that home or if you wanted to sell the home in the future. So we're going to get into that and break it all down for you.
All right, that's what I like to hear because I have a lot of clients who are interested in just not just traditional homes, but mobile homes as well, manufactured homes as well, and all these questions come into play.
Right.
So why don't we start with what is the difference in terms of a lender's point of view when a client comes and they're looking to actually purchase one of these items, one of these homes. What is the difference? Could you tell us what's the difference between that?
Okay, so it's not like a big difference between a manufactured home and a mobile home. The mobile home was classified as mobile home if the home was built before 1976. So 1976 is a really important year for any home that wasn't built from the ground up. So the manufactured mobile homes, anything that was built before 1976 is considered a mobile home. And then the second part of that, mobile home is classified as a home that have wheels. So if it has wheels, then
I
it's
am
considered a
mobile.
mobile home because it's movable,
Yes.
right? And a manufactured home is simply that. It's a home that's built in a factory. The factory brings it to the site and pretty much either sits it on a site with the wheels, or they would take the wheels off and they would tie it down or fix it to the foundation. So
It's
let's
more
dig into it.
fixated.
Yep.
It's more permanent.
More permanent. Yeah. Put it on beams so it can be more permanent as if it was built from the ground up.
Okay.
So yeah. So let's go a little bit deeper. So manufactured homes, a lot. So here's the thing about manufactured homes, and this is what I've noticed being in the mortgage industry. When people buy manufactured homes, they usually don't shop for a lender for that manufactured home. They usually go to the builder, and the builder usually have their own internal lender to use to initially build that manufactured home. So if a person is like kind of new, if they, let's say a manufactured home is already built and a new buyer wants to buy that manufactured home that's listed on the market for sale, then that person will typically just go to a lender because the home is already built. But
Exactly.
right. So for a person that's looking to build their home and they want to go the manufactured route, a lot of times they will go through that builder, and that builder have their own internal lender that will help them with the financing. But here's the thing people need to be really careful about. That builder have their own lender, so that lender can kind of have their own like little stipulations and can let things bypass a little bit, such as single I'm trying to think of the right word to say, double, like a double wide or a single wide.
Mm-hmm.
So a builder, their lender will do a single wide manufactured home, which is okay, which is fine. However, if you try to refinance that home in the future, that lender may not do refinances. So you will have to go to a traditional lender to do the refinance. And here's the part that's going to get you. Most lenders do not refinance a single wide home. So in today's code, lenders will only refinance a double wide or higher. You can
So
purchase.
so that's just the same. Well, excuse me, that lender, chances are, is working with that builder anyway. In essence, it's kind of like when someone's looking for new construction.
Hmm.
And instead of, going to a traditional lender, they'll go to that lenders that's working with the construction company.
That's exactly what it is. That's
Exactly.
exactly what it is. Yep. And that lender that's working with the manufactured home have the ability to finance that home as a single wide. But again, you got to be careful, because if you want to refinance it in the future, and most people do, because as things break down, you're going to need a new roof. Manufactured homes tend to wear and tear a little bit faster than a traditional home that's built from the ground up. So if you try to go to a traditional lender and try to refinance that home and it's a single wide, they're not going to do it. They want their homes double wide or larger. So when you're looking to build a manufactured home, the first thing you want to do is make sure that that home is a double wide or larger.
Good, 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 good. That's what's up. Because here in Connecticut, I mean, we do have several mobile parks and manufactured homes, but I don't think it's the traditional way that people normally go. So it's always questions when you do have someone that says, I'm willing to do that and I'm interested in that. Also, how about, we're going to jump around, but the park fees on that home, the mobile home, those park fees can range from a couple of $100 up to, even, I don't know about 1,000, but I guess it's depending on the condition of the park. I want to talk about when I have a client who is interested in purchasing a home. However, you always have to take in consideration with the taxes and those fees. Those are including the condo fees, the park fees. Those fees can take an individual who was previously qualified to now no longer being qualified. Talk
That
about
is
that a little bit in terms of your as a lender.
that is correct. So, and here's the thing. I'm glad that you mentioned that, park fees. Because yeah, park fees are included as part of your debt to income ratio. Going back to that lender that does the homes for the builder, they're going to, chances are they're going to allow that borrower to purchase that manufactured home that's in a park. Now here's something else you have to be careful with. The park, the lender, a traditional lender, will not refinance or let you purchase a home if that home is in a park. So that means if the home is in a park, the buyer does not own the land that that home sits on. So a traditional lender, the qualifications are, it needs to be a double wide or larger. The property, the manufactured home, needs to be tied down or fixed to the foundation, so wheels off. It needs to be, you need to own your own land. So even if the land is financed through the bank, you still own that land as part of your mortgage payment. So it cannot be in the park, because you don't own that land. The park owns that land, or the property manager owns that land, or whoever, the city owns that land. Whoever's in charge of the maintenance of that park, they own that land, not the borrower that's purchasing the manufactured home. So that's why, in general, when a person is looking to purchase a manufactured home and it's in a park and they're shopping around for lenders, they're going to have a really hard time finding a lender to finance that home because it's in a park. The original lender financed that home when that manufactured home was first built, because they were working with the manufacturer of those mobile homes. So as far as park fees is something that a traditional lender, we wouldn't even calculate because we don't do them.
So that makes it that much difficult for someone who purchased a property, and
It makes it that much difficult. So
unless you have cash.
unless you have cash. So my advice is for anyone that's looking to take that manufactured route, make sure it is not in a park. Make sure you own the land that that manufactured home is going to sit on, and make sure, even if it's that payment is part of the mortgage, like most traditional, if you was getting a house built from the ground up, you own that land that that house is going to be built on. Same way with the manufactured home. If they're bringing it from the warehouse to the site, you own that land that the home sits on, unless it's in a mobile park. So we don't include those park fees because we don't even finance homes that's in a mobile park. It has to be structured like a single family house.
Okay, that makes sense. Well, that's interesting because you
Yes.
learn new things.
Something that people don't know about. I get calls all the time from people that, especially in California, because California, the price of manufactured homes are a lot cheaper than a single family house out there. We already know in California, home prices are crazy out there anyway.
Yes, they
So
are.
yeah, so people want to purchase a home and they say, "Hey, I found a home in a trailer community. I want to get finance for it," and we say, "Hey, we can't do it because it's in a park community. We don't finance homes that's in a trailer park community. It has to be a single family home in nature. In Yeah, a single family home in nature, manufactured on a single family land,
And not in a park.
not in a park."
Okay. And also, when people are looking for mobile homes or manufactured homes, sometimes you can find some at really good discounts or rates 33, 50,000. I mean, really good if they're in good condition, or however, if someone wants to purchase them. Do
Yes.
you finance for that amount? Whether it's a manufactured home, mobile home, or just in general, a single family home, what is the lowest that you finance for? Because I noticed that some lenders have a minimum amount that they will finance. They won't go below that.
Yes, good question. So our minimum here at Norcom is 50,000. That's for all homes, manufactured, single family, all condos. That's for all homes. Our minimum is 50,000. However, if you go to a traditional bank, Key Bank, Chase, one of those type of banks, banks usually their minimums are usually a little bit lower, especially for like condos, because we're going to talk about condos as well, but because condos, their home prices tend to be a little bit lower. So banks usually go a little bit lower with their minimum requirements, minimum loan amount requirements. So if a person is looking to, say, buy a manufactured home and it's in really great condition and it's not in a mobile park, all the other qualifications, they meet that, but the price is a little bit lower, I would say maybe visit a traditional bank or a credit union and see what their minimums are, because a lot of times they don't have minimums.
Okay, that's good to know.
Also,
Right.
with a manufactured home, let's talk about the refinancing. And this is why all of this is important, what I talked about before, as far as financing it through the builder versus buying a home through a manufactured home through a traditional lender. When it's time to refinance that home, because it's going to happen. You're going to probably want to use some of the equity in the home, or you want to, to do repairs around the house, because again, manufactured homes, they tend to wear and tear a little bit faster than a traditional home. So when it's time to refinance, there's a couple of things you have to be a little bit careful about. FHA, refinancing a manufactured home using the FHA loan, you have to go to a 20-year mortgage. That's their requirement for FHA. It
Mm.
has to be a 20-year mortgage. Conventional, however, you're able to go back to a 30-year. Some people, they they purchase a home, a manufactured home, and let's say that person might be a little bit older, and that person say, hey, I'm not going to ever pay this mortgage off. Let's take it back to a 30-year so I can have a lesser payment. You can do that with a conventional loan. However, with the FHA, if you refinance it, you have to come down to a 20-year mortgage.
So
So, so
go ahead.
Oh no, so I was just going to say something that you keep in mind when refinancing a manufactured home doing an FHA mortgage. I would suggest to just make sure that your credit scores are in the right place, so that way you can go conventional and you can kind of tailor your loan to be able to go 30 or 25 year if you don't want to do that 20-year mortgage and have your payment increase a little bit.
Okay, okay. Well, hold on one moment. I'm sorry. Got off track here. I actually have someone who chimed in with me on
Okay, did they have a question?
they have a question.
Okay, go ahead.
Put your question in the chat. We appreciate it all. But yeah, she wants to know about the 20 years. If you could just repeat about the 20 years, the 20-year mortgage in terms of, like you said, if you refinance, it has to be 20. You can't refinance to 30 or 15. What's that about?
Okay, so no, for FHA, you can go 15-year if you wanted to, but the minimum is a 20-year. The only way that a lender will let you go, so that's FHA requirements, 20-year minimum. If you were to refinance a manufactured home using the FHA loan, 20-year minimum.
Okay, so
however,
go ahead.
There's like some rules. You can go 15-year as well. As long as your debt to income ratios are in line, you can go 15-year, but the minimum is a 20-year. However, you have lenders that can override that, and they will override that with their own risk. They would say, okay, we can take this back to 30-year, but we're going to keep this on the books. So they're not going to it's going to be a portfolio loan. So they're pretty much going to keep it on their books and take in that risk for them going 30-year. But traditionally, if you're refinancing a manufactured home using an FHA loan, it's going to be at a 20-year, 15-year, or 10-year. You can't go back to a 30-year like you can with a conventional loan.
That was Benita.
That was Benita. So I just repeated that. So let me know if you need me to say it again, or if you kind of understood what I just said. So on a manufactured home, if you're using the FHA loan and you try to refinance it in the future, it's going to have to be at a 20-year mortgage. It can be 20-year or less. So 20-year, 15-year, 10-year, or anything in between. However, if you go conventional and you wanted to say go back to a 30-year mortgage, you could go back to a 30-year mortgage. And yes, that only applies to manufactured homes, not a traditional mortgage where the home was built from the ground up. Only manufactured homes.
Wonderful.
Yeah. Also, here's another thing about manufactured homes that a lot of people don't know. So it's a lot of caveats to a manufactured home. The interest rates are a little bit higher on a manufactured home compared to a regular single family home, because mortgage lenders, we base everything off of risk. So the riskier the loan, the higher the rate will be. So risk is based. So mortgage lenders consider manufactured homes a risk because it's built inside of a warehouse. So they're going to hit you for that. And they're going to hit you by upping the interest rate compared to a home that can be in that same neighborhood. It can be built the same style, but one was built from the ground up, the other one was built in a warehouse. It can have the same amount of equity, but that person whose home was built from the ground up, their interest rate is going to be a little bit better because it was built from the ground up versus the person who has that manufactured home. Is considered a little bit more riskier.
Because it's a different type of home.
It's a different type of home.
The wind can come and blow it.
Yeah, pretty much.
It has been done. It has been done. Okay.
Right.
That's what's up. Anything else on the manufactured home?
I don't know, like, if anybody else have any questions about a manufactured home, but that's just like some pieces to it, and just making sure that the home is registered through your local DMV as real property. That's another important thing. You want to make sure that is register as real property. So I'm gonna go over that real quick, really fast, just like some things for people to remember. If you purchase in a manufactured home, make sure it's a double wide or larger. Make sure that it is not in a community park. You want to own the land that the home is being built on. Make sure your make sure it's tied down or fixed to the foundation. So if it comes with wheels, you want to have them wheels taken off, have it tied down and fixed to the foundation, and make sure it's registered with the DMV as real property and not as a mobile home. Also, you're going to get an engineering certification with a manufactured home. Please keep that engineering certification. Keep it for life. That engineering certification is good for life. So when you're purchasing, when you're getting a manufactured home built, the builder is going to issue you a engineering certification. It's going to tell you everything about that manufactured home and how it was tied down or how it was fixed to the foundation. It's going to pretty much detail everything about that manufactured home. Engineering certifications are pretty expensive. They can be like 500 plus. 500 plus. So if you lose it, and let's say you want to sell your home, yep, sell it, you're going to have to pay for another engineering certification. You're going to have to, which is costly. And then let's say if you want to refinance it, now you're going to be coming out of more money because you're going to have to get an appraisal done, which can be 500, 400 plus, depending on what area you live in. Then you're going to have to get that engineering certification again, which is 500 plus, on top of, all the other expenses that comes with refinancing your home. So those are the two things that you will be paying out of pocket when you're refinancing the manufactured home, will be the appraisal and an engineering certification if you lost it. So again, if you're getting a manufactured home built, keep that engineering certification in a safe place so you don't lose it, because it can be costly trying to get another one, another engineering certification done.
Now, is that similar to like the home inspection?
No, it is not similar to a home inspection. The engineering certification pretty much, engineering certification is almost similar to an appraisal. So the engineer is going to come out there to make sure that the house is actually sound. They're going to check to make sure that the home is on the beams. Wow. Yeah, make sure there's no hazard with that home sitting the way it's sitting. Manufactured homes, those codes, they update yearly. So sometimes it's a little bit of tweaks according to the government of how they want manufactured homes built. So if it's something major that needs to be done and you need to get another engineering certification done because you lost the first one, then that new engineering certification is going to come back and say, okay, according to the new codes, you need to get this done, versus having that old one and you'll be good to go.
Now, that engineering certification is needed when you are going to want to sell that property.
Sell or refinance.
Or refinance. That's good to know.
Both, sell or refinance.
Good to know. Okay. Well, that's not mobile and manufacturing homes. Anything else you can come up with?
No. No, let's talk about some condos. And townhouses.
Condos. You gotta love condos.
Mm-hmm.
You can't get enough of those.
Right.
So what you got about condos in terms of, we have the same situation or a similar situation with the fees, because those fees can go up and it can screw up the debt to income ratio for the individual, the condo docs. Their laws and bylaws. Mm-hmm. Condos has a lot of different variables to them. A lot of people don't like, well, I can't say. Some people don't mind doing condos. Some people do. Condos in terms of, they can have some variables to them. So they're not, to me, just like the traditional single family home.
Right. So condos are, they're becoming like a little bit popular with, I guess, the younger generation, because, home prices are out the roof still. They came down a little bit. So a lot of people I'm not going to just limit that to younger people. Even like, I guess, empty nesters that's trying to downsize and they say, hey, I want to go into a condo. So what people have to realize is that condos, there's a lot of stipulations that's involved with purchasing a condo, and it doesn't have to be a hard process. It's just making sure that you're working with a realtor that knows how to transaction a condo home. So a lot of realtors, surprisingly, they don't do condos because of so much. It's so much to it, so much caveats to it. But again, it doesn't have to be a hard process. So one of the things you want to look out for when doing a condo, if you have an FHA loan, you want to make sure that that condo is FHA approved. A lot of condos are not FHA approved
They're not.
because, yeah, yeah, because surprisingly, condo associations, they don't want to deal with it. They think that it's such a big hassle, and it's really not. Only thing you have to do is fill out some paperwork, and that's pretty much it. You just have to fill out some paperwork which details all of the information about the house, how much is in reserves. It's really not a long process to get an FHA condo approved. I think that a lot of the condo associations, they have this I'm not sure what word to use, but they have this thing thinking that FHA means something other than what it actually is. So they're categorizing FHA as, oh, like low income, but
Like
it's
it's
really
not.
not. So
It's
they, yeah, and it's not. So they try to, I guess, wean themselves away from approving, having their FHA, having their condos FHA approved. And, I think it's just a
They
shame
went
that,
streamlining people from coming into their condo area.
right. Right, pretty much, pretty
Okay.
much. And it's really not a hard process to get it approved. It's just that condo associations, they just have this thing with FHA loans. But jumping to the conventional side of NVA, jumping to the conventional NVA side of FHA, of condos, you still have to make sure that the condo is approved, even with a conventional. And a lot of times it is. A lot of times it is. But here's a couple of things you need to know about purchasing a condo. You have to make sure that the condo have enough reserves in there. So this is some things that lenders are going to be looking at. They're going to be looking at the reserves, making sure that people are paying their dues on time, because everything, again, is a risk to the lender. Also, there has to be a number of owner occupied units compared to rentals. So you have some condos where they do allow you to rent. So the number of rentals compared to units is a little bit, it's 80-20, I want to say. So no more than 20% is allowed for, I'm trying to make sure I'm saying this right. No more than 20% of the condo can be rented.
Rentals, exactly.
Right.
A lot of condo docs will say if you purchase this property, you have to wait a year to be able to rent, or even longer than that. Some don't even allow you to rent because you get a lot of investors who come along and want to fix the
Right.
condo up, and then they think they're gonna rent, and that condo association is not having it. They're like, no, that's not what we're doing. You
Right.
can't do that here. So yeah, you're right about that.
Right. So that's what lenders are looking for. They want to see what the number of units are rented compared to the numbers that are homeowners, because at that point, if you have a larger pool of rentals, it's not considered a condo, it's considered an apartment building. So
Exactly.
that's what lenders are looking for. Something else that lenders are looking for, they want to make sure that, again, I said that they want to make sure that the HOA fees are being paid on time, because everything is a risk to the lenders. So they want to see how much is in reserves. They want to see the bylaws. They want to make sure that your homeowner, the building insurance is being paid on time. So it's a lot of things that's, it's not too difficult, but just things that people want to be aware of when they are purchasing a condo. The first thing they should ask is, can I get a copy of the bylaws so they can see what the stipulations are in the bylaws, so that way they won't run into a last minute hassle that can stop them from getting that home approved through the lender.
Definitely. Also, sometimes when the condo association or the condo itself need repairs, How does
Yes.
that repairs fall down on the tenants, the owners? How do they split the fee? If the parking lot needs a new um, paving, who's going to pay for that?
That's part of the HOA fees. So that's yeah. So that's the reason why the tenants, the owners, pay HOA fees to maintain the common areas, maintain the grass, maintain the
Yes.
roofing, the furnaces, the driveway, trash collection. So that's part of the HOA fees, and
But
also
doesn't that go up sometime, like in the event, the roof or things like that? If the condos, everything is connected, and we need a brand new roof, the association comes together and they estimate how much it's going to cost. That's split amongst the individuals who are the owners, right?
yes, if there's not enough money in reserves. So reserves,
Exactly.
that's what reserves are for as well. Reserves supposed to cover all of that. So the condo association should have enough money in their reserves because the HOA fees are paid monthly. So the condo association should have enough money in their reserves to cover everything, to cover roofing, to cover. Now let's say a roof needs to be done and some other work needs to be done. So the condo association could say, okay, we need to do some major repairs in this building. And although you're paying the HOA fees every month, yes, we have to go up on the HOA fees so we can continue to build the account, the escrow account where the HOA fees are held, and also so we can make sure that the building is being maintained. So yes, so you're right. HOA fees typically does go up. However, when the HOA, so let's say when you're purchasing, let's go back. When you're purchasing a condo, you're first purchasing a condo, they're going to go off of the HOA fees for that unit at that time. So let's say the HOA fees, let's say it's $200 per month. So let's say it's $200 per month. You got your offer in. The lender is calculating out all the numbers. Your debt to income ratios are in line. So you're good to close. Now, let's say a year from now, HOA fees go up. That has nothing to do with the lender because your loan is already closed. So
Mhm.
once the HOA fees go up, you just got to make sure that you're budgeting correctly to account for any increases in HOA fees. So the lender is only looking at the debt to income ratio at the time of purchase. So that's something that a person needs to be really careful about when purchasing a condo. They have to budget future for
Increases.
future increases with the HOA fees.
That makes sense. What about, let's switch up a little bit. So, okay, wait a minute. So, are you done with the condos? We can just talk about anything at this point.
Unless somebody has some questions. Condos is pretty simple. I mean, it's not a lot to it. It's just some things that you have to make sure that you're careful about. So I'm done with the condos, unless you had something else that you other questions that you wanted to touch on.
Well, let's talk about what's the current interest rates right now.
Okay, so interest rates they actually came down a bit.
Let's
So
see. That's what I'm talking
yeah,
about.
interest rates interest rates came down a tad bit. Let's say I want to say November of 2000 of last year, October, November, they were like high six, low sevens. Yeah, low sevens, high six. Now they're in the low six, high fives. So you can get 5.99. I've seen interest rates at like 6.25. So they're starting to come back down a bit. And I think that probably within the next 6 to 12 months, interest rates are probably going to be in the. This is just my prediction. I'm not an economist, but this is my prediction. The
Okay.
way the rates are, the way the trending, the rates are going, I think the rates are probably going to be at high 4%, between high 4%, 5% range by the end of the year.
Okay.
That's just my prediction. We don't know for sure, but I think if inflation continues to cool off, the interest rates are going to come down. And I'm glad that you mentioned that because that just brought me another point up with the condos. So I'm going to jump back really quick.
That's fine.
Rates for condos, like manufactured homes, rates for condos are higher than rates for a typical single family home because again, condos they are more riskier, and they're more riskier because the borrower is in a unit that's being managed in a building that's being managed by a property manager. They have other owners in the unit, so everything is a risk. If somebody's unit get caught on fire, that's going to affect the next unit as well. If the person can't continue to stay in their home, so everything is based off of risk. So condos, the interest rates are a little bit higher compared to a single family home.
Okay. Okay. All right. What else? I think that's it for today.
I think that was a great conversation. Something that
Conversation. I didn't have anything else. Well, that's something. That's for another day. That's for another day. I was gonna say something, but that's for another day. Um, but yeah, we are going to. Anything else? That was it.
I don't think I have anything else. So as always, if you're looking to
Exactly.
purchase, refinance, or reverse mortgage your home, people don't know what reverse. Somebody has a question. How does
Yep. Hold on. We're gonna put it up there. Oh, Bonita. Thank you, Bonita.
how does she?
How do you see the market? What are your opinions differ on whether we will have a crash compared to 2008, 2009? Wait a minute.
Oh yeah, I get what she's saying. She asking. She said typo. I get what you're saying.
Yeah.
So she's asking the predictions of the market, and do she think we're going to have another crash like 2008, 2009? Benita, no, I don't think it's going to be another crash. Not like I think there's too many laws in place to prevent another market crash like we had in 2008 and 2009, or worse. Yes, or worse. I don't think that's going to happen again because there's too many laws in place right now to prevent that from happening. Well, to hopefully prevent that from happening. Let's say that because we can never predict if another 2008, 2009 is going to happen, but laws were put in place so that wouldn't happen again. But I honestly do not think another 2008 market crash is going to happen. I just don't see it. But again, I'm not an economist, so we don't know what's going to happen in the future. I just hope that it doesn't happen again because that didn't only affect the mortgage industry, that affected the world in general with jobs, people get laid off. That was just a bad time, and I wouldn't wish that on anyone. So let's just hope that doesn't happen again. But again, there's laws in place to prevent another market crash like that.
Yeah, and I hope we don't know. We don't want that to happen.
We don't want that to happen. Right.
Even the banks was falling apart. Everything was
Mm-hmm.
falling apart. So that was a whole lot going on.
Right.
Bonita got praying hands. You right about that.
Right. Right. We definitely don't want that to happen because people outside of the mortgage industry were losing their jobs as well. So it was a ripple effect. It just didn't affect the mortgage industry. It affected a lot of different sectors as well. Other sectors that doesn't have anything to do with mortgage lending.
And people lost their homes and just
Mm-hmm.
their livelihood. Everything was terrible.
Right.
But what they say, even though people lost this, a lot of people made a whole lot of money. That's the investor. That's the other side of
That's the
real
other
estate.
side of the business. A lot of investors made a whole lot of money in the upper echelon. They made a whole lot of money
Like they say, you
off
make money in a
off of that
recession.
market crash.
Yeah, you make money in a recession. You have to be ready at any time because when the time hits, it hits. So you need to be ready for it.
Right.
So if you that person that want to invest in real estate or get yourself involved in a 4-family house, 3-family house, or whatever it may be, during recessions, people become millionaires.
People
Look at
become
COVID.
millionaires during
It
recession.
wasn't necessarily a recession, but it was a pandemic. And look at COVID.
Yeah.
A lot of people became
A
millionaires.
lot of
during
people
COVID.
became millionaires during the COVID. We're in a recession now, and people are still making money profiting off of the real estate industry, whether it's buying a
Exactly.
physical house or even just
Right.
through through REITs, a real estate investment trust. People are making money off of that as well. So I encourage people, if you're looking to get into real estate, and if you're that type of person that's like, hey, I don't want to be a landlord, I don't want to be a property manager and be worried about tenants, get into some REITs. I think that's a great way to, because I'm that person. I'm not a landlord type of person. I don't want to deal with that. So I invest in real estate by doing REITs. That's a good way for me to earn money, and still be in the real estate industry outside of mortgage lending in real estate, selling real estate. I like to do the REITs because I'm not a tenant, a landlord type of person.
Yeah, that's not for everybody.
It's not for everybody.
That's not for
Hmm.
everybody. I totally agree. But that's a perfect example how people do make money in a recession.
Right.
So that could be another conversation because I love that type of stuff.
Yep. Yep.
I love that type of stuff. But Bonita, thank you. We appreciate you
Thank
for
you, Benita,
chiming
for
in
joining us.
and engaging with us. We had a couple other people on. They had gave us some feedback, just some smiley faces. We appreciate that. So we do plan on coming out another each week on Friday
Each week
between
on Friday. Join
six,
us.
6 and 6:30.
Right, right. So I'm just going to give you guys my NMLS number so you guys know I am a
Right.
mortgage lender, and I'm with Norcom USA. I'm licensed in the state of Ohio, Florida, Tennessee, Illinois, Colorado, and Texas. So if you know anyone that's looking to purchase a home in any of those states, please feel free to reach out to me. My NMLS number is 1781437. Also, if you're in the state of Ohio and you're looking to sell a home in the state of Ohio, I am a realtor in the state of Ohio as well. So in the northeastern Ohio, Cleveland Akron market is where I sell homes.
Ah, well, there you go. And I'm Sabrina. I'm in Connecticut.
Yes, yes. What
So
market do you serve? Do you serve the whole state of
yes,
Connecticut?
I do. The whole state
Okay.
of Connecticut interested in buying, selling rentals. I am your girl in the state of Connecticut.
There
So
you go.
give me a
She serves
call.
the whole state. I don't serve the whole state as a realtor.
Yes, you can. If you and I'm with EXP Realty. We are statewide, countrywide. So
Countrywide.
exactly.
International. You guys are international.
International. So
Yes.
if you are interested in something that's not in Connecticut, I still
You
can
can
be
help
your
them.
girl. Definitely, because we partner with other agents all across the country. So
Absolutely. Absolutely. That's
absolutely.
big. You guys are international. That is big.
That is big. That's big because you one agency. We still one agency. We global and we work
Mm-hmm.
together. So we there's no need if you can't find a house here in Connecticut and you want one in I don't know Chicago, California, Dubai,
Dubai, Africa,
Dubai,
South Africa, you guys are in now?
Africa. Yeah,
Mm-hmm.
we are all over. So if you have family in Connecticut that want to relocate to another country, give me a call because I
Yep.
do have someone that can help you.
There you go. There you go. Yep. Okay. So I think that's it. So Sabrina, till next time, we're gonna have some good topics for you guys next
Yes,
week.
you will.
We can't wait to speak with you and to see you all next week. And until next time,
Thank you. Bye bye.
bye.
Did I get it out? Oh, here we go.